Hey everyone, and welcome back to another episode of Simply Wall Street's Market Insights. My name is Michael, and this week we're talking about Bitcoin Treasury companies. If you want the full breakdown, including charts, links, extra data, and our coverage of what happened in markets last week, you'll find the article linked to in the description. Now, let's get into it. Because we covered it last week, you may already be familiar with the Bitcoin ETFs, but Treasury companies, they take things a step further. They aren't passive vehicles, they're companies that actively raise capital to buy Bitcoin and construct financial products around it. Their entire business model is a bet on Bitcoin outperforming their cost of capital. At their core, it's a three-part formula: acquire Bitcoin, raise money however they can, and use smart balance sheet strategies to keep the cycle going. The idea is to exploit the spread between their funding costs and Bitcoin's expected long-term appreciation. If Bitcoin grows faster than their interest payments, they do well, and shareholders get leveraged exposure along the way. Importantly though, many large investors like pension funds or fixed income portfolios still can't hold Bitcoin directly, or even the ETFs in some cases. So these companies step in and offer exposure through equity or structured securities like convertible notes and preferred shares. That current scarcity of opportunities creates premiums that investors are willing to pay, at least for now. So who's leading the charge? Well, the clear frontrunner here is Treasury. Once a humble analytics company, it's now transformed itself into the largest corporate holder of Bitcoin in the world, holding 628,000 Bitcoin worth around $71 billion as of August this year. That's more than double what it held just a year ago. But it's not a one-company show. In Japan, Metaplanet is mimicking the playbook with a string of Bitcoin-backed securities. In the US, Semler Scientific shocked investors when it pivoted from healthcare into Bitcoin. Smarter Web company, Cantor Equity Partners, which is soon to be called 21, and even a Canadian vape company have all joined the ranks. What many of these companies typically have in common is a weaker or stagnant core business. Bitcoin has become the pivot, the product, and the pitch. For some, it's a genuine long-term strategy, but for others, it's a branding refresh to attract attention. And as the movement grows, the field is getting crowded, which brings its own risks. So here's the catch. Investors have been paying steep premiums for exposure through these stocks, sometimes up to 4 times the value of their Bitcoin holdings, or what's called MNAV, multiple of Bitcoin net asset value. Why? Well, scarcity, simplicity, and sometimes a bit of FOMO. But as you can imagine, as more vehicles come to market, like ETFs, ETNs, or just new entrants, those premiums can compress. Strategy's premium, for example, has already shrunk from 4x to 1.5x in just under a year, even though it bought hundreds of thousands of coins. That means the share price didn't keep up with Bitcoin, and in fact it dropped by about 30% from its peak. It's similar to how a P/E ratio can compress. Even if a company's earnings rise, the stock can fall if investors are less willing to pay a premium for it. Grayscale's Bitcoin Trust is the poster child for this, trading at a premium for years, flipping to a deep discount, and only closing the gap after it converted into an ETF. The takeaway here is that premium-based trades can work until they don't. Now here's where it gets really clever, or complex, depending on how you look at it. These companies are using financial engineering to fund their Bitcoin purchases. First, there's equity. If their stock trades at a premium to their Bitcoin, issuing shares is a no-brainer. They raise cash, buy more Bitcoin, and increase Bitcoin per share for current holders. But once that premium narrows, the equity play loses appeal. Next up, they have convertible notes. Treasury has issued 5 of them maturing between 2028 and 2032, mostly with yields under 1%. Investors buy in for the chance to convert to equity if the stock runs higher. But if it doesn't, Treasury has to refinance or repay the debt, and that can add pressure. Then there are preferred shares, which are hybrids of debt and equity, often perpetual and offering juicy yields. Strategy's got 4 flavors on the menu, including STRK, STRF, STRD, and STRC. These securities vary in risk, yield, and seniority, and that's the key because in a downturn, the capital stack matters. Preferred holders get paid first, common shareholders get whatever's left, if anything. So now let's talk about the downside risks. In a Bitcoin bull run, this model spins like a flywheel. Raise capital, buy Bitcoin, price goes up, stock goes up, raise more capital, rinse and repeat. But when Bitcoin falls, that same flywheel can spin into reverse. the stock price drops, MNAV premium compresses, funding dries up, and dilution kicks in. In some cases, companies might have to even sell their Bitcoin to stay solvent, which ironically puts more pressure on Bitcoin's price. Now the thing is, if Bitcoin enters a prolonged bear market, companies face a choice. Issue equity at depressed prices, rack up expensive debt, or liquidate their Bitcoin holdings. And none of those are appealing options. In a worst case scenario, if Bitcoin's value drops close to the company's debt load, common shareholders can get wiped out entirely. That's why so many of these firms are leaning on preferred shares. No repayment of principal, just dividends. But even those depend on capital market access and investor demand. And remember, under new US accounting rules, Bitcoin is now marked to market for corporates. So if Bitcoin drops, companies book paper losses, even if there's no actual cash impact. That can seriously spook some investors who don't read past the headlines. So what should you do? Well, read past the headlines. And what's the insight here? Bitcoin Treasury companies aren't just Bitcoin exposure. They're leveraged Bitcoin exposure with complex mechanics. For investors who know what they're doing, they can offer powerful upside. But you need to know how to price the premium, model different funding scenarios, and evaluate management's capital raising ability. On Simply Wall Street, you can start by exploring our global Bitcoin stock screener to see what's out there. Then build your investment narrative. Figure out which companies are smart allocators and which ones are just chasing the hype. Take a look at different angles, like this iron narrative versus the AI analyst coverage of Riot platforms. They both give Bitcoin exposure, but they have different risk profiles and narratives. And finally, remember, timing and portfolio sizing matters a lot. These plays can go parabolic in a bull run, and they can decline just as fast in a downturn. Premiums are a double-edged sword. Use them wisely. And that's where we'll wrap up this week's Market Insights. If you want to dig deeper into the data, charts, and company breakdown, just follow the link in the description. But let us know what you think in the comments. Do you think the flywheel will speed up or slow down for these Bitcoin Treasury companies over the next 12 months? And if you found this episode helpful, please feel free to like, share, and subscribe, and let us know what topics you'd like us to cover next. But that's where we'll leave it for today. We'll be back next week with more Market Insights. Until then, invest well.